What's going on, everybody? Liam O'Reilly, Vermont economic realtor. Hope you're doing well. So far, as a result of the Silicon Valley Bank collapse and the Signature Bank collapse, as well as the drama with Credit Suisse today, we have seen U.S. Treasury yields drop significantly. We've seen mortgage rates drop significantly over this past week. They've both dropped very quickly. So what is going on? What does that mean for you as a home buyer or seller? Is now a good time to buy? Is now a good time to sell? What is this going to do to the U.S. housing market? So let's first take a look at these yields and what is going on in the bond market. So here is a chart of the 2-year Treasury. We can take a look at what it's done over the past year. You can see as the Federal Reserve has raised their Fed funds rate over the past 12 months here. Rates on the 2-year Treasury have gone up with it, right? People who can get a better rate with the Federal Reserve, typically will choose that over even a slightly risky asset like a U.S. Treasury, even though it's virtually no risk. But as you can see, yields have dropped as people have flooded into the bond market. And if we go into the 10-year Treasury, we see the exact same thing. This is a 5-day chart of what's happened. So you can see pretty flat, pretty flat, pretty flat, then all of a sudden steep decline, another steep decline. So this is, why do we look at the 10-year Treasury and why do we look at the 2-year Treasury? Because this is what mortgage rates follow. And why do mortgage rates follow these Treasury bond yields as opposed to the Fed funds rate? Because the Fed funds rate is a short-term rate. That's an overnight lending rate. It's a lot different than a longer 30-year mortgage rate. So the type of people who are buying those, the type of people who are putting their money in the reverse repo facility at the Fed to get that Fed funds rate are not necessarily the same. They might be the same people, but it's different money than would be used to purchase a longer term return like a 10-year Treasury or a 30-year fixed rate mortgage. So the reason why the 10-year Treasury and the mortgage rates are linked is because people who buy mortgage-backed securities are going to look at what assets to put their money in, and they're kind of considering, should I get a higher return with a mortgage-backed security, or should I get a lower return with a safer asset like the 10-year Treasury? So all summed up shortly, that's how they're correlated. So as these bond rates drop, that's going to influence mortgage rates significantly. And if we take a look at NEFQ's website here, 30-year fixed rate is at 6.125%. And if you watch my videos from about a week ago, you'll know that that rate was at 6.75% and was pretty much there for the past 2 or 3 weeks as the Federal Reserve and Jerome Powell was testifying in Congress about how we're going to keep rates high and we're going to keep it high for longer. And now that we haven't seen inflation come down, although the CPI report wasn't too bad yesterday and the PPI report was pretty positive today. So maybe that will, maybe that's shifted things. But in regards to what's going on in the banking system and what the Fed raising the Fed funds rate this quickly has done is it's caused these banks to have an imbalance in their balance sheet, right? They have assets that aren't worth what they were when they purchased them, because as yields rise, prices fall, right? Because we're not, a perfect example, the US government isn't issuing any new treasury. So in order to get a higher yield for the same treasury, if you buy a US treasury and you pay $100 for it and you're going to get a 2% return, in order to get a 5% return on that exact same treasury, it's got to be sold for a lower price. So as rates have risen, the prices of these assets that are held by the bank have fallen, held by these banks have fallen, which is causing issues and causing a collapse. So now, what does this mean for the housing market in the U.S.? Now, here in Vermont, I think that means that right now is probably the best time to buy, as long as you're not worried about losing your job. If you have a safe, secure job, I think now is the best time to buy. Probably that we'll see in the upcoming months, maybe over the next year. And the reason why I say that is because rates are still pretty high right now. Rates are still pretty high, but now that there's cracks in the U.S. economy and cracks in the banking system, the chances are higher that the Federal Reserve is going to pivot. The chances are high that the bond yields are going to continue to fall and that rates are going to drop. And now if rates drop, then people, affordability is going to rise, right? People can pay more for their home. The thing is, especially here in Vermont, we don't have a whole lot of inventory. So it's just more money chasing the same small amount of goods, which is going to cause prices to skyrocket here in Vermont for sure, but also across the country. Really what we need is more building. Now, I think this will have an effect on building, and it will cause more builders to go into the market. Maybe not some of these markets that have seen a significant decline over the past 6 months, but certainly in markets that are still undersupplied and there's a lot of demand. So that's why I think right now is a good time to get into the market before the rates drop. Yes, you will have a higher monthly payment than if you waited, but there should be a little bit less competition right now. And if rates do drop like we're expecting them to, then we should see increased demand into the housing market, which will cause prices to rise, more competition. It's going to be harder and harder to get into a property than it is today, even though especially here in Vermont, it's still difficult to get into a property. I think it's going to become more competitive over the upcoming months. Now, how this could play out in a scenario, in a negative scenario, and why now might not be the right time to buy is if we see mass layoffs, and if people start losing their jobs, and the whole system really starts to crumble down. I personally, I don't think that's going to happen, but it could happen. If everybody's losing their jobs and can't pay their mortgage, then we're going to see foreclosures. We're going to see more supply come to the market. We're going to see demand crushed because people don't have the money to pay their mortgage, to get pre-qualified, because they don't have a job. So if that happens, then obviously it'd be better to wait and save your money and purchase when everybody is losing their homes. Will we see that? Personally, I don't think so, just because there are so many jobs available and there are so many people employed right now. Of course, if the economy shrinks, people might lose their jobs, but unemployment is still at an all-time low. So as of right now, the jobs market remains strong, which means if rates drop essentially preemptively, instead of keeping rates high and letting banks fail, which could cause mass unemployment and cause a whole collapse of the entire system, I think dropping rates will probably save the banks, save the businesses, but make the housing market very, very competitive. Now, I have a couple notes here that I'm going to look at to just get to my next point. So I guess what I was saying with the higher rates, you can always, if you purchase a home now, you can always refinance when rates drop. So if you buy now and then rates drop and prices continue to rise, which is what I personally think is going to happen here in Vermont. I mean, it's what I am looking to do. I am going to be submitting an offer this week, ideally. That is my goal, to submit an offer this week to take advantage of the current market of these elevated rates and where prices are at now before rates drop and things get more competitive. So, if you can always refinance out of that in about a year. If rates do drop and they are around 3 or 4%, you can refinance and get your monthly payment lower than it was. Now, what else do I think is going to happen in this housing market is if rates do drop significantly, it's going to spark the move-up buyer, which is going to add supply to the market, which will be great. It will be much needed. Right now, I've talked about this a few times on the channel, the move-up buyer is stuck. The people that are first-time home buyers that are living in a 2-bedroom or maybe a 3-bedroom, 1-bath property, that their family is growing, they're outgrowing their space, those people have been forced to stay put. Not forced, but essentially their options are keep their cheap monthly payment with their low interest rate, or sell this property, get a 6, almost 7% rate, buy a property that's way more expensive, increase their mortgage payment from maybe it's under $2,000 a month to over $4,000 a month. That puts a lot of strain on a family. So if rates drop, we will see supply start to increase and the move-up buyers start to come back. At the same time, there's going to be more competition. There's going to be more buyers in the market, which is why I think this week, the near future, I guess really what you have to decide is, what do you think is going to happen out of all this? Do you think that the whole system is going to collapse and there's going to be joblessness and nobody is going to be able to afford anything, and we're going to enter into a really deep depression like the Great Depression. You know, if you think that's going to happen, then your best bet is to probably wait and take advantage of when, you know, people are forced to leave their homes and don't have jobs, you know, if you have the money to wait. But if you don't think that's going to happen, personally, I don't. That's not what I'm betting on. That's why I am looking to get in and purchase a home in the near future. Then your best bet is to get in while these rates are a little bit higher, while demand is still lower than it will be in the future, and ride the wave as rates drop and home prices rise. So that's my advice for home buyers. All my contact information is in the description. If you're looking to buy or sell a home here in Vermont, reach out to me directly. I'd be happy to help you. Let me know what you think about this video. Do you think I'm right? Do you think I'm wrong? What do you think about the bank collapses? What do you think about the bond yields dropping? What's going to happen in the future? Let me know your opinion. I love hearing from you guys. Other than that, Liam O'Reilly, Vermont Economic Realtor, and I'll see you in the next video.